Hi and welcome to Swissquote's Daily Market Talk. It's Wednesday, September 17th. The Fed is about to announce a 25 basis point cut later today, but also reveal its latest dot plot that will give us more clarity about the officials' intentions regarding the coming month's rate cuts in the US. So expectations are very dovish, mind you. Short-term yields in the US are under pressure. The US dollar index trades near a year-low level and the S&P 500 at a record high. But given how dovish the expectations around the Fed have become, well, we could see some disappointment today. So we will talk about all that and more. But before we do, please keep in mind that opinions are my own and this is not financial advice. So the S&P 500 broke one more record yesterday before the widely awaited Fed decision of today, while the SOX 600 index fell more than 1% as rate-sensitive sectors, including banks and insurers, led the index lower. Then the US 2-year yield that best captures the Fed rate expectations remained under the pressure of dovish Fed expectations, and activity on Fed funds futures assessing nearly 100% chance for a 25 basis point cut today. Around 80% chance for another 25 basis point cut in October and 70% chance for a third 25 basis point cut in December. From there, while many expect one more rate cut in the next meeting, some actually foresee as much as 6 rate cuts in the next 6 Fed meetings. Meanwhile, bets for a half-point rate cut this year from the Fed, not today, but maybe in December, are actually gaining momentum among option traders because the latest data actually suggests that December options, which will expire just 2 days after the Federal Reserve's December monetary policy announcement, hint at we could eventually see a 50 basis point cut before this year ends. This is what the option traders are betting for. In summary, the market expectations are getting softer by the day regarding the Fed policy, and the US data backs dovish expectations because inflation remains under control and not spiking due to tariffs. The jobs market is weakening while consumer spending seems to be holding up well. Yesterday's data actually showed that retail sales in the US grew more than expected by analysts in August, around 5% on a yearly basis. That is a strong number, but as it is the case in the stock markets, the strong figures here hide the underlying dynamics in consumer spending because wealthy Americans, for example, who also are heavily invested in financial markets that are doing incredibly well these days, now account for almost half of the US consumer spending. While JP Morgan-backed fintech company Slope said that its credit line surged 730% because of the tariff this year, as companies actually try to cover their tariff costs and avoid a cash crunch. But none of this is obviously visible in the headline economic data except for the jobs figures, and the latter justifies a part of the recent dovishness around the Fed. But there's a chance that the Fed does have actually gotten ahead of themselves over the past few weeks, which could eventually lead to some disappointment today if Jerome Powell decides to keep the inflation risks on the table and the Fed's dot plot shows less rate cuts expected by the Fed members themselves compared to what investors are expecting right now. So all eyes are obviously on the Fed decision and its latest dot plot that should give us some more clarity on how big and how fast the Fed officials are thinking that they will be softening the US monetary policy. Now, normally, the lower the yields, the higher the support for the economy and the better it is for the stock valuation. So that's just something that's very much understood by everyone. But a too dovish stance from the Fed could eventually revive the idea that the Fed is actually under a political pressure to lower the interest rates more than needed, and or the economic situation in the United States is worse than many think, and that's probably hidden by the record-breaking stock rally in the US, mostly shouldered by the US big technology companies and the demand for AI, and could eventually weigh on sentiment broadly. I guess we will soon find out. But in the meantime, news continue to come in and boost appetite for the US technology stocks, and Oracle is having its best time this year, to say the least, after announcing a massive deal with OpenAI. Remember, earlier this month, the company is also part of the much expected TikTok deal between US and China, because the company will apparently house the US users' data. Bingo, the share price spiked yesterday before giving back some of these gains and still closed the session some 1.5% higher. In the FX, the US dollar index fully erased its summer gains and is now back to the lowest levels since summer and the lowest levels this year. Cable, on the other hand, advanced to the highest levels since July, regardless of the political turmoil in the UK and the budget concerns that actually weigh on UK's growth prospects and political stability. So yesterday's jobs data from the United Kingdom confirmed the weakening jobs market in the UK. Even though the numbers were not just too bad, wages growth slowed but remains well above the levels that would tame inflationary pressures. And while speaking of inflationary pressures in the UK, which has become a huge problem since the pandemic times, while the CPI data freshly out this morning actually did confirm that the price pressures in the United Kingdom remain strong enough to justify a no action from the Bank of England at this week's monetary policy meeting. So the latter, a cautious tone from the Bank of England versus a dovish Fed expectation. A dovish Fed outlook should keep cable in demand, but sterling is set to ease further against the euro, where inflation seems to be under control, and the strength of the euro comes from the rising organic demand for the euro as a reserve currency, the euro area bonds, and euro area stocks, especially the defense stocks as such. Yesterday's sell-off helped the euro dollar break the back of the 118 offers, along with the waning attention on the French political drama, even though that drama is still on. The final Eurozone CPI figures for August are due today and should eventually confirm that inflation in the euro area is steady around the 2% mark, which is also the ECB's policy target. Stable oil prices and stronger euro certainly help. So a set of CPI data that are in line with expectations will just reinforce the idea that the European Central Bank is certainly done cutting the interest rates this year, widening the monetary policy outlook gap with the Fed softening expectations for the months to come. And that divergence between the ECB and the Fed actually does pave the way toward the 120 mark, regardless of what the Fed will say today, unless it's really not as dovish as expected. In the commodities space, gold consolidates gains on the back of softer US dollar, while silver is under pressure this morning with a 1.24% retreat at the time I'm talking here this morning. On the other hand, US crude jumped yesterday to $64 per barrel level on the back of a bigger than expected decline in the US weekly oil inventories, and the rising tensions in Ukraine also help keeping oil bulls timidly in charge of the market. But note that solid resistance is still seen into the $65 per barrel level. That includes a key Fibonacci level and 50 and 100-day moving averages here. In Asia, while equities are led higher by technology demand yet again, the technology-heavy Hang Seng Index hits a fresh 4-year high this morning, with Baidu up by more than 15%. In Hong Kong this morning, on news that the company sealed an AI deal with China Merchants Group, which is a major Chinese state-owned enterprise focused on transportation, finance, and property management. While the Chinese Alibaba and SMIC are both up by around 5% today on the back of the same AI optimism, and these stocks remain relatively cheap compared to their US peers, mind you, because Nasdaq's Golden Dragon Index has a PE ratio of around 15, and that's nearly half of the PE ratio of the Magnificent 7 companies. So it's quite hard for some to return to the Chinese technology stars I know after the 2021 crackdown from the government, but the momentum is building actually, and the AI really is happening in Asia. So this is all for today. I'm İpek Özkardeşkaya and thank you for joining me and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions and your questions below as usual. Follow us on Instagram, on X, on LinkedIn, but also on WhatsApp, Threads, Telegram and Blue Sky for regular market updates. Subscribe to our YouTube channel for daily market comments and please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow and until then, good day trading.